What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is March 16th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to spend some time to break down the topic that everyone is buzzing about at the moment, and that's the upcoming Federal Reserve FOMC meeting, where the Fed is going to be discussing potential changes to monetary policy. And in today's video, I want to break down what this is going to likely mean for crypto markets. I want to go ahead and turn towards history and really try to get a macro understanding so we can answer this in the most non-biased and reasonable way possible. We've got lots of things to dive into in today's video, and I hope you guys will stay tuned because it's jam-packed with a lot of information. But one thing I wanted to share is that if you guys find that the content here on DataDash is not enough, if you guys want to find more conversations, more thought leaders and opinions on these kind of topics like the Federal Reserve, then I highly recommend you guys go ahead and subscribe to the DigiFox YouTube channel. This is my crypto startup, and we recently launched the new podcast that we've been working on called The AMP, where we interview a wide range of high-level individuals in the crypto space, like Mayor Francis Suarez, who was our first episode, as well as traders like Dr. Chris Katcher, who I've been friends with and tracking in the space for some time, John Devadas, as well as Mayor Scott Conger, a lot of highly respectable people in the crypto space. And we even dove into this conversation around the Fed's monetary policy in many of these conversations. So if you're interested, check it out if you guys are looking for some good long format content. But without further ado, let's go ahead and dive into this topic here around the Fed. Now, as you all might likely know, and I just want to go ahead and provide this context for those who may not know, the Federal Reserve manages two key forms of monetary policy. There are some other different various means they can use to kind of stimulate or manage markets, such as the repo markets, but we're really going to be talking about the two things today. Interest rates, either rising or lowering interest rates to increase or decrease the cost of capital or credit in the economy. And the other move is through quantitative easing or quantitative tightening. And this is where the Federal Reserve can basically effectively print new money in order to buy up toxic financial assets or even reputable assets like treasuries or other forms of government bonds or corporate bonds, and basically add more cash into the system for lending activities, for financing, for all types of different things. And vice versa, when they engage in quantitative tightening, they would start to basically sell those assets on the market, taking cash out of the system, right? And the idea here is that between these two activities, when you generally lower interest rates at the cost of capital, and when you generally print more money and take some of those assets off the market, this will stimulate asset prices. It'll generally lead towards an increase in asset prices over time. That's the general knowledge that most people have around it. But it's a very simplified view, and I want to go ahead and emphasize why there's a lot more nuance than people may think when it comes to understanding Fed monetary policy. People usually think that so long as the Fed's printing money, so long as they're lower interest rates, assets are going to go up. And generally that is true. But it doesn't mean that the moment the Fed stops this or starts to reverse course, that everything is doomed. And that's the narrative I really want to focus on here today. Now, the Federal Reserve is likely going today to enact its first interest rate hike. This is going to be of about 0.25% or 25 basis points, to put it simply, a quarter of a percentage, right? Now, a lot of people are worried about this because the Federal Reserve has not raised interest rates for the preceding few years. And when it did start on a hiatus, basically, of raising interest rates back in 2018 and tapering monetary policy or stimulus, in this case, engaging in quantitative tightening, that was when we started to see the market start to take a little bit of a hit, right? Now, all the while that is generally true when it came to the equity markets, I want to go ahead and focus on what happened with crypto markets. That's the most important here. And I'm going to go ahead and bring you all towards the chart that you need to see here, because even though the Fed is likely to raise interest rates here today, and that's really what we need to consider today because that's the only action the Fed is likely going to take, let's go ahead and take a look at the federal funds rate. This is the federal funds rate that the Fed can raise interest rates on or lower interest rates on. Basically lower or increase this base rate or cost of capital. Now, as you can see here, it's been practically sitting since back here in April of 2020. In nearly 2 years, it's been sitting flat here in order to protect the global financial system and to keep money circulating at a cheap cost during the pandemic in order to keep businesses flowing, not disrupt supply chains, etc., right? And to be completely honest, it makes rational sense as to why the Fed does some of these things. I'm not here to talk about whether it's good or bad, but it generally happened. That's the key thing we need to understand. Now, all the while, a lot of people might be really worried to see that, oh my God, we might be raising interest rates like we did back here. The Federal Reserve has gone through waves of raising interest rates in the past. And it usually only starts to provide issues for the global economy, at least from what we can see over the last few rate hikes, when it's over a multitude of years, or at least at a minimum, a multitude of months to 1 year. Right? So that's one thing that's important to keep in mind. That's when it really could start to contract on assets. But I want to go ahead and focus in on really the most recent rate hike here, because Bitcoin as an asset really has only been around since 2010, 2011 on basically publicly traded markets. In this case, where people would pay anywhere from a couple cents to where they pay tens of thousands of dollars now for Bitcoin. But over the past few years, we had one of these rate hike phases, and this was back in 2018. Back here during 2015 going in to 2019, right? So it was a multi-year phase of raising interest rates. Now, if you turn to look at equity markets and the broader asset classes out there, the housing market, you'll actually find that assets in general appreciated during this time. During this period of rising interest rates, they all actually still performed quite well. It had a generally non-effect on asset markets. But if you take a look at crypto, that narrative is even more true. Crypto, from November 2015, when the Fed initiated hikes and rates, going into when they actually had lowered them all the way down from the peak to the trough here in this case, bottom to top, right? We can see here that Bitcoin not only had a strong bull market where it went from around $200 per coin up to $20,000, but also even as it went through a bear market was able to recover its price back up towards a percentage return of nearly 2,400% from November 2015 to April of 2020. Not so bearish to me, if you ask me personally. Now, sure, crypto had greater returns in the past, but going from $1 to $100 is much simpler than going from, for example, $100 to $10,000, right? And it's going to take longer to make those kinds of returns. You're not going to get it in the same period of time. You need much more liquidity, much more interest, much more users coming into the network to really get that value appreciation. The fact that Bitcoin did a 2,400% return, roughly speaking, from the beginning to the end of the Federal Reserve rate hikes, that is truly incredible stuff. All right. Now, again, and I want to talk about the kind of resiliency here of crypto, is that during this period of time, we were stepping in, and the reason why rates dropped off from 1.5 down to practically 0%, which were remaining at, generally speaking, for most of the last decade. It's important to note here that as rates dropped down here, right, we were going through one of the biggest financial crises in history, bigger than the housing bubble, the pandemic that we were going through, where global supply chains were disrupted, things were really tossed off on the side. And all the while, crypto's prices, even though it went through a flash sale like other assets, rebounded quite quickly and still has maintained as a profitable asset on a general annualized basis more than any other asset class out there in the market, whether it be equities, commodities, like Forex exposure, whatever you can think of. Crypto has remained resilient, and more specifically, Bitcoin has been leading the way here. And we can see that all the while interest rates have remained low or they've been hiked over time, Bitcoin still continues to climb. And that's the really important thing to focus on here. Interest rates generally are a non-event, in my opinion, for crypto. Some people see rising or lowering interest rates as bullish or bearish, but I really don't think they have an effect. And here's why. Until interest rates get towards double-digit territory, right? Really, or upper single-digit territory, for example, like they used to be back here in the 90s or back here in the late 80s here, for example, as we saw the heightened levels of inflation and therefore the Fed contracting with heightened levels of interest rates to cut the cost of capital and keep excess money from entering in the system. Interest rates don't really bother financial markets too much. So I'll give you an example here of how this actually plays out. One of the big stories that people have constantly talked about, and we wrote about this within the Dash report back about a month or two ago in one of our letters talking about this FOMC meeting that was coming up a previous few months ago. You take a company like MicroStrategy, one of the largest corporate companies that's publicly traded, that's been going out and buying large sums of Bitcoin. That's been pretty much their business model over the past year or two outside of their core business operations. Now, what MicroStrategy has been doing is, because it's such a cash-rich business, it's been basically going out and taking out loans on the open market for anywhere around like 1.5% annual interest payments on that debt in order to go out and buy large sums of Bitcoin. Now, you might be thinking to yourself like, whoa, like I wish I could borrow at that kind of APR. And the thing is that for these kind of enterprise companies, they can get really competitive rates for, basically building, like creating convertible notes or debt in this case, for various people who are aiming to get large tranches of money, earning some kind of yields on their capital. That's just how cheap credit can be in the system nowadays, especially with a cash-rich company that's financially sound like MicroStrategy. But putting all that aside, I'm rambling. The major point here I want to emphasize is that there's a reason that interest rate still has some cost to it, right? There's the federal funds rate, and there's also the margin the bank needs to make. But if the base cost of capital, or the Fed funds rate, increases by 0.25 basis points, like everyone is so fearful of right now, this new trend that the Fed might start raising rates, that would likely take that loan, if the MicroStrategy wanted to, manifest a new loan with a new lender, that would probably take it up to 1.25, maybe 1.3, maybe even a little bit more where the bank is making more margin, around 1.5 to 2%, right? Now let me ask you this here. Do you think that Michael Saylor and the team at MicroStrategy really give a crap as to whether or not they're able to borrow $500 million to buy more Bitcoin at 1% or 2%? Michael Saylor doesn't care. MicroStrategy wouldn't care one bit. And that's not going to freeze them from taking $500 million and going out and buying more Bitcoin and betting even heavier on their narrative that they believe Bitcoin is going to be a leading asset going forward. And I can tell you all, the same exact scenario, even for someone who is maybe less like zealous about Bitcoin and like huge and a big fanatic of Bitcoin like Michael Saylor might be, you will find the same in institutional investors. You will find the same in hedge funds. You will find the same in anyone out there who has that kind of access to credit and uses it to purchase financial assets. That's the reality of the world. It's the world we live in. And the reason why is because, to be completely honest, Bitcoin's annualized return, having to pay a 1 or 3% annualized interest rate is nothing. The difference is negligible, right? Sure, you would like to have it at maybe 1% versus 2 or 3%, but no one's who is that confident in taking out credit to buy financial assets like Bitcoin is going to stop at the opportunity of borrowing that money just because the interest rate is a little bit higher. And that's the key point to understand here. Even if we were to reclaim where we were back here in 2019 at 2.4%, you can see that it really had a negligible effect on crypto. Even when we were at heightened interest rate territory, Bitcoin started to recover here throughout this entire period of time, right? This is a really big telltale sign that it just doesn't have any effect here on crypto markets, right? And you can see here as well, when we lowered interest rates as well, right? When we went down to the race to zero, look at how Bitcoin performed, right? Went generally sideways. There's no cause and effect relationship when it comes to interest rates. In my opinion, it's a negligible non-event. Now, what many people will tell you after that is they'll go, Nick, okay, yeah, we get it. Interest rates may not be the big culprit here, but the Federal Reserve is also going to probably talk about step number 2, which is going from quantitative easing, which it's continued to do, to quantitative tightening. Well, for those of you who are concerned about this, I think it's a very valid concern because quantitative easing, moving towards quantitative tightening and reducing the balance sheet, is something to be a little bit cautious about. And if we take a look at history here, when the Fed actually started reducing its balance sheet, it did have an effect here on equity markets. For crypto, it was generally non-negligible in this case. There really wasn't much of an effect, at least according to the previous one we saw in the past. So I just wanted to go ahead and point that out. But let's go ahead and talk about the reality of the scenario here. And first off, take a look at a really great source here from Yardini.com. This is the chart here of all the central bank balance sheets, right? So you've got, the People's Bank of China, Bank of Japan, ECB, or the European Central Bank, and the Federal Reserve, 4 largest central banks out there on the planet. And you can see that combined, they added trillions of dollars in new currency into the system, right? Effectively in the United States, we've more than doubled the money supply since back here in 2020 within a matter of just about 2 years, which is absolutely insane, right? Even if the Fed starts to reduce its balance sheet, and that's a big if, and I'll get to that in a moment, there is still so much cash in the system. There's still so much money out there. And that's why the Fed talks so confidently about, look, like, yeah, we really got to taper this thing because the inflation that you're seeing in the economy right now, the still quite strong resiliency you're seeing in assets proves that there's too much money in the system still. right? So I wouldn't be too surprised if the Fed goes out in the coming months and actually maybe starts quantitative tightening, right? But I want to go ahead and emphasize one big point here, and we have talked about this since the beginning of the year. We have drilled this, and I've beaten this like a dead horse in this case, effectively. The key thing to understand here about the Fed talking about reducing monetary policy or reducing its balance sheet purchases is that, like the Fed has a history of, it likes to talk the talk rather than walk the walk. And I guarantee that today, the Federal Reserve isn't going to make any moves here when it comes to actually reducing its balance sheet. Maybe it'll slow down the purchases of assets. Maybe it'll commit to potentially making reductions in the future, right? But it's all talk and talk, and then there's a new macro event, a new scare, a new thing for markets to worry about. Assets in the stock market decline 15-20%, and the Federal Reserve, basically comes to the rescue. The markets cry wolf in a sense. So they cry to Powell, please stimulate the markets. And that's, again, what the Federal Reserve has done time and time again. It's played this tightrope game of actually trying to reduce things, but in reality, not really getting away with it and supplementing more supply to the market, right? And that's what's led to this historic inflation that we've seen. This is a big point here. I've shown this chart a couple times here, but I really want to emphasize why it's important to have exposure to assets right now, guys. While it's important to get yield on your wealth right now and to not have it sitting in a bank account, it's the worst thing you could do right now. Inflation can last a lot longer than people think. Rolling annualized inflation back in the 70s lasted for multiple years. This red line here, starting from January 2020, maps a very similar trend to what we saw back during 1972, going into the mid-70s. And it can spell a lot of trouble for everyday people, even in periods of time where it might go higher and lower. It can get into double-digit territory, and it can remain there for a long period of time. What we're seeing right now in inflation is probably midway through the crisis itself. And as geopolitical tensions grow, supply chain issues persist, it's only going to get worse. It's only going to get worse. Now, I don't mean to be negative in that sense or like try to be the bearer of bad news here, but I want to be realistic with you all and showcase that the Federal Reserve has a long way to go to taper inflation. And the fact that it's just doing a 0.25% basis point move shows that the Fed is not really serious about this and doesn't feel that the pain is big enough yet. Because see, what happened back during when inflation was starting to get severely out of control, Fed Chairman Paul Volcker back in the 70s and 80s enacted a massive hike of rates. And that's exactly what you guys saw here on the charts here, back here during this period of time, right? We can see here that there was a massive spike higher. And what it did is that in the short term, it created a recession. It created a pullback in equities. But you know what? It wasn't that severe. And on top of that, the Federal Reserve was actually able to prove once in its history, that if you take the hard necessary decisions, you can still maintain the trust of the people. You can mitigate inflation in the economy. You can get things back to the way they were before, where prices are stable and the system starts to adjust to make the necessary moves in order to restructure as an economy. Unfortunately, the Federal Reserve has ignored this. It has not made this move, and it's likely due to a few other variable factors. The amount of debt in the economy as a portion of GDP. There's a lot of macro factors that maybe weren't a problem for the Fed to consider back here in the 70s and early 80s that they have to worry about now, right? We've been on more than a multitude of decades of easy money generally, a downtrend in interest rates, making the cost of capital cheaper and cheaper. And all the while this hasn't really helped contribute to economic growth, it has stimulated asset markets far and beyond. Major point that I want to focus on here is this. Whether the Fed starts tapering or not, whether the Fed starts raising interest rates, we've got a whole lot of money in the system. And Bitcoin really doesn't give a crap either way. Crypto is still so small as a market comparative to the others out there. Bitcoin is an asset right now at its current market price is around a $650, $700 billion asset. Global equities, easily a $120 to $125 trillion market. You do the math on which one is more likely to double, or the kind of odd game in this case, which one has the odds of doubling or tripling over the next year or so. more than the other, I would probably go with crypto because of the market's scale potential that it has, a global digital store of value, the asset that the majority of millennials and Gen Z investors are putting their money towards. And as the great wealth transfer happens over the coming decades from the boomers and the retirees right now into the lower generations, that capital is going to flow somewhere. And it is likely going into cryptocurrencies. So anyways, I've rambled out a good amount, guys. I think this has been a really interesting macro topic. But one thing that I did want to point you guys' attention to is that during this time period of excessive inflation, excessive money printing, and stimulus from the Federal Reserve, and no matter what direction they really go, as I've mentioned earlier, it's important to have that commitment to protecting your money through various assets. And even though we talk a lot about crypto here on the channel, one really good partner that I would recommend you guys take a look at is our sponsor for today's video, which is iTrust Capital. iTrust Capital is a cryptocurrency IRA that allows you to invest in cryptocurrency assets in a tax-advantaged way through an IRA account, so you can actually defer any tax obligations on an income or capital gains basis. And on top of that as well, they even offer the ability to have physical gold and silver digital ownership. So to have actual ownership of physical gold and silver owned in a actual like stored mint facility where it's protected, it's real hard assets. You're not investing in paper contracts like GLD in the stock market. So if you guys are interested, definitely check out iTrust Capital at the link down below. They're a great partner of ours here on the channel, and it can be a great way to start building that protection against inflation over time. But that being said, everyone, that's it for today's video. I have rambled on more than enough, and if you guys have made it this far in the video, I can only say thank you for tolerating my rambling. If you liked my rambling, consider giving a like to the video, consider subscribing, hitting the bell icon, checking out the various links down below in the description in order to support the channel and access some pretty cool services. But until the next one, everyone, thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.